For Wall Street Media, this is Nikki. I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
We kind of match, right?
Kind of. I'll give you like this
much of a match?
This many points.
All
That's
right.
like 0.3 of a point
That's
for
a lot of
matching
points.
today.
That's a lot of points for today.
Guys, good stuff, man. It's brutal out there right now, but this is when the rich get rich, and this is when you make your money. You just don't know this is when you make your money in this kind of a market, okay? We've got a guy that's a superstar, genius, ethical, and he's here for us exclusively, and you need to watch this to get a handle on what's going on right now.
Rich Gordon, fixed income market strategist of Wachovia Securities, WB, discussed the effects of this week's series of extraordinary events, including the bankruptcy of Lehman Brothers and the purchase of Merrill Lynch by Bank of America.
I bought some of their shares today, Wachovia.
Yeah?
Yep. Let's see what Rich Gordon has to say.
Hi, and welcome again to Market Summary Online. After a long weekend of negotiations, Lehman Brothers filed for bankruptcy on Monday morning and will enter into an orderly sale of its assets. Also over the weekend, Bank of America agreed to acquire Merrill Lynch at a 70% premium to Merrill's closing price on Friday afternoon. And so the credit crisis claimed the scalps of two more investment banks. Here are some of the major effects and implications of this extraordinary series of events. Back in March, the government was criticized for increasing the risks of moral hazard that were raised by accepting what was effectively a sizable first loss piece in the Bear Stearns J.P. Morgan acquisition. This time, the U.S. provided no direct financial support to make a deal for Lehman more attractive for potential acquirers. But the Fed did take several steps to ease liquidity conditions surrounding Lehman's balance sheet unwind. The Fed expanded the size of their liquidity lending facilities for investment banks. They broadened the types of collateral it would accept, including providing financing for equities, and also relaxed the rules restricting banks' transfer of funds to and from various subsidiaries. Also, in the private sector, a consortium of 10 major dealers set up a $70 billion financing facility to keep markets more orderly and ease liquidity issues surrounding key financial firms should the government's liquidity programs prove insufficient. Here are a few observations that I think are fair regarding the changing face of the financial industry's structure. First, the Lehman failure is distinguished in several ways from the Bear Stearns situation. For one thing, market participants have been on notice for several months that Lehman Brothers was a weak hand, so many traders have either reduced outright or hedged their exposure. On Sunday, a special trading session was convened in order for dealers' CDS exposures to Lehman to be netted out, as well as providing the opportunity for dealers to add additional macro hedges before the markets opened on Monday. Second, after applying a rough calculation of the potential costs and benefits of various alternatives, the remaining major banks and dealers concluded that the best thing for them was not rescuing Lehman, but instead to buy Lehman's assets out of bankruptcy at deeply distressed levels. The assets that they purchased would then be financeable at the Fed's liquidity facilities. While these firms might have some losses from any net Lehman exposure that they had, the strategy of letting them fail and buying their assets very cheap gives them two things: theoretical upside in the value of those assets, and it eliminates a major competitor. It's Darwin's survival of the fittest theories applied to major financial firms. The fallout from all of these events created a new wave of significant asset revaluations and volatility. Investors rushed to buy treasuries in a classic flight to quality. The 30-year Treasury bond gained more than 5 points Monday, and 2-year Treasury yields dropped by 50 basis points. The spread between the 2-year yield and the Fed funds target rate reinverted for the first time since April. Many analysts and traders are now expecting the Fed to begin cutting rates again. And they might very well do that to avert the failure of other major financial institutions, but I see this as more a problem of balance sheet capital rather than centered on liquidity issues. It's not clear to me that in and of itself, rate cuts will reverse the sharp devaluation in the value of the financial assets that we've seen over the past 13 months. Particularly in periods where credit losses act as a 100-mile-per-hour headwind, it takes lending institutions a long time to repair their capital bases by restructuring their balance sheets. I agree with Secretary Paulson's comments during his news conference on Monday that the markets probably won't stabilize until the housing markets and home prices stabilize. Stock markets worldwide were hammered on Monday. In the U.S., stocks held up as well as could be expected in the morning, but by mid-afternoon, a key support level on the S&P was broken. By the end of trading on Monday, the S&P was down almost 5%, its largest one-day percentage decline since September 17, 2001. The banking sector was very hard hit by the failure of Lehman and the uncertainty surrounding AIG. The KBW Regional Bank Index was off by almost 8.5% Monday, and the CDS on the 5 largest U.S. banks widened by 85 basis points. The large-scale liquidation of Lehman's balance sheet will pressure spread products of all types and probably result in further mark-to-market write-downs for banks in the third quarter. Both idiosyncratic as well as systemic risks increased from the weekend's events, and as a result, traders bought protection in the credit default swaps indices aggressively on Sunday and Monday. The CDS, IG, and high vol indices both widened sharply by over 40 and 75 basis points respectively. It's clear that the unprecedented shakeout that's underway in the financial industry is both inevitable and necessary. Between the late 1990s and today, there's been a rolling asset bubble that was created by unnecessary excess liquidity from central banks and capital markets. This liquidity glut fueled undisciplined risk-taking on both Wall Street and Main Street. First, it drove the price of certain stocks to absurd levels. Then when that burst, the investment dollars shifted to home prices and credit spread products, and then to commodities. As the rolling bubble of leverage and risk finally deflates, it's leaving in its wake shattered financial balance sheets and a much smaller financial market. As a result, the strongest hands are absorbing the weakest. It all sounds simple and economically straightforward. Unfortunately, the amount of leverage that was allowed to be added to the financial system through derivative contracts over the past 5 years complicates the issue, because the failure of any major financial firm could cause a ripple effect that adversely impacts liquidity and capital positions of others. This is why there's more concern and potential systemic fallout surrounding the outcome of the AIG situation. It's a larger counterparty in the credit derivatives market than Lehman was and has a balance sheet nearly twice the size as Lehman's. It's simply not clear to me that risks in the financial sector are isolated enough that the Fed can continue to allow the free market to resolve all of these potential failures. One way or another, I think the only potential resolve in this crisis is for the Fed to provide even more balance sheet support, or we risk a prolonged period of financial asset deflation and a vicious negative feedback loop that slows the economy even further.
Really good stuff.
Great stuff.
Fabulous stuff on a special day. Okay? We'd like everyone out there that's watching us to write in and tell Nikki happy birthday. Wonderful. Thank you. Many happy returns. And that's the best of both worlds.
We're here every day at Wall Street Media. You can find us directly at WSMCO.com. Thanks.